Good morning, everyone, and welcome to the session. Today's session is Don't Panic, Fair Reserving Amidst the Chaos. We have two fantastic presenters today for you, Colette, Reid, and Matthew Wood. They have done some amazing and interesting work on IBNR and disabled life reserve for group insurance business, and they're going to share some of that insight with you today. Firstly, a little bit about the authors. Colette became the CFO and Chief Actuary of AXA Life Re Australia in November 2020, having previously been the appointed actuary of Pacific Life Re in Australia. She has 30 years of experience working in life and general insurance and reinsurance in Australia and Europe, across pricing, reserving, capital, portfolio, and reinsurance management. Colette is the Fellow of the Institute of Actuaries and has regular involvement with the Institute and APRA on product, regulatory, and appointed actuary-related topics. Matthew Wood is also a Fellow of the Institute. He's the Chief Compliance and Risk Officer of AXA Life Re Australia. He joined the team late last year. He has over 25 years' experience working in senior consulting and corporate life insurance roles across Australia, Europe, and America, including pricing, reserving, business planning, strategy, capital management, M&A, compliance, and risk management, of course. He has regular involvement with the Actuaries Institute, with a particular interest in actuarial education, including being the chief examiner for the Part 3 life insurance exam. Matthew was born and bred in the UK. He travelled around the world and fell in love with Australia and hasn't quite managed to leave. Now, I'm going to hand over to Matthew to start this exciting session. But before that, I want to let you know that there is a box on your right-hand side of the screen called Comment, and you can ask questions as the presenters speak, so that I can see the comments. They will take question at the end of the first part, and so as the question comes to you, feel free to put them in there, and then we'll get them answered. So without further ado, I'm going to hand over to Matthew.
Thank you very much, Hoa. Thank you for that lovely introduction. No, I haven't quite managed to leave yet. And why would I? It's a beautiful country. So this presentation today, we've done a bit of work looking at group insurance, and I'm sure a lot of you valuation actuaries and appointed actuaries out there are panicking a little bit at the moment with everything that's going on in the regulatory space and in the COVID space. So the squirrel there on the left is in a bit of a panic, dealing with IBNR, GSC, TPD, DLR. But don't worry, it's all under control. This presentation today is to try and help you to relax, to be more like the cat on the right with the cucumbers on his eyes. And don't worry, all your reserving will be okay.
So to give a bit of an introduction to this presentation, there's a lot going on in the market at the moment in both the retail and group spaces. So there's, as people would be aware, there's a lot of regulatory change going on inside superannuation, with Protect Your Super and putting members' interests first legislation changes. There's a lot of regulatory focus on retail IDII products. There's been letters from APRA recently on the group market, earnings volatility, and ASIC has also given voice to their views in their recent 675 report. And as Matt said, COVID-19 has also complicated claims process and claims experience. Obviously, there's a lot going on in this presentation. We really did just want to focus on a couple of key themes. So we did really just want to focus on the group market, and specifically TPD and GSC issues. And I guess what we're putting forward some kind of thoughts and proposals in this presentation, which are by no means a right or wrong answer, but really just to stimulate a bit of thought and give people some ideas about how to approach some of the challenges in setting assumptions and in reserving for group business. So to start with IBNR, I'm sure quite a few people are aware of the December 2014 LIW-MPC discussion note, which did a bit of a deep dive into various IBNR reserving methods. We've listed them out there. I think it's probably fair to say that the ones that I've seen in popular use have been chain ladder and Bornhuetter-Ferguson method. With the recent volatility in the market, there's been some discussion about, what's driving that, whether it's a step change in experience or a change in reporting patterns. And some of these IBNR methods perform better or provide more stable results than others when reporting patterns are changing. And so now we've actually got a poll question for the audience. If you want to join at slido.com, there's a QR code and also a numerical code there. And we're just interested to know what IBNR reserving methods people are using for group insurance at the moment, and you can choose more than one method there. So I'll just give people a minute or so to join the poll and let us know what their views are on that.
All right, so your vote's coming in. Thank you.
That's great. Thank you. So that's really interesting to see and probably not very surprising, to be honest. So with that knowledge in mind, perhaps we can move on.
Oh, they keep moving.
Oh, it's still moving around.
Let's give it a few more seconds.
Yep.
Oh, we go. Excellent. So chain ladders, clearly the most popular at the moment, which, not surprising. Oh, and additives popped in. All right, thank you. That's interesting.
Yeah, so we can see that chain ladder is probably the most traditionally used method with BF and the ultimate loss ratio and additive on there. I think there was some other box as well, which is
it's hard to see.
A bit hard to see, but probably not too many surprises in those results. So with that in mind, we'll move on to the next slide. We did a bit of work to try and dig into whether there was any evidence for accelerated reporting versus a step change in claims experience in the group market. So we had a bit of a look at the APRA statistics, which obviously are pretty high level and have some advantages and disadvantages. So in the top graph there, you can see we've plotted premiums and claims cost, which includes reserve movements. And with the introduction of PYS in 2019, we can see that volumes are falling off, which is probably to be expected. And claims are also falling, but at a slower rate and are lagging the volumes. So then we tried to pull apart the claims cost into the actual claims revenue cost and the reserving cost. That's in the bottom graph there. So you can see that claims revenue has actually dropped in line with premiums, which we would expect with the drop in membership after PYS and PMIF. However, claims reserving has been somewhat more volatile, dropping. There was a sharp decrease in March last year, but since then it's actually been increasing. So I guess the hypothesis we had was if volumes are falling, claims cost is falling, and then why are reserves also not reducing? And we kind of suspected that there's probably a little bit more going on in reserving. And if there has been an acceleration in reporting, are people nervous about allowing for that too early or baking too much of that into their reserving?
Okay.
We also did a bit of work to compare the chain ladder method, which is, as we've seen, has traditionally been quite a popular and widely used method, with the additive method, which I guess has been less popular or less widely used. I think because it's a bit more simplistic. There's a risk of under reserving. It's probably not considered to be as sophisticated a method as some of the others. So when we tested this for group business for death, short-term IP and TPD, we found we got very similar results for death and short-term IP, and the main differences were being seen on TPD, which I guess makes sense because TPD is probably more sensitive to reporting changes in reporting patterns. And so you can see in that graph, the grey line is projecting the ultimate number of claims using the additive method, and the orange line is projecting the ultimate number of claims using the chain ladder. The additive method gave a nice kind of stable expected development pattern, whereas the chain ladder, we struggled to explain some of the volatility in the projected ultimate claims cost, and in particular, we couldn't really determine why there was this kind of spike in experience around the time that PYS was coming into play. And so then obviously using the two different methods will give you a different IBNR calculation, and potentially just using chain ladder unadjusted is baking in too much of the accelerated reporting as ultimate claims cost. And potentially there's scope to use an adjusted chain ladder or a blend of, those two methods, or, some other adjustment to try and allow for some element of accelerated reporting. So on that basis, that's really what we wanted to talk about on IBNR. I'll probably pause there and see if there's any Q&A coming in before we move on to the second part of the presentation, which focuses on disabled lives reserves and GSC.
Thank you, Colette. Very interesting findings there. I think people are still probably digesting that, so maybe we can move on to Matthew's section, and then I'll note the questions and come back at the end.
Thank you, Cara. Thank you, Colette. So, yeah, disabled lives reserve. So, just first of all, we thought we'd just talk a little bit about the what's happening in the retail market. It's well known there's a lot of issues at the moment regarding sustainability. There's been some very large market losses, north of 1 billion. A lot of regulator interest, particularly the APRA, IDII, thematic review. And of course, there's now this mandation around using the ADI table, the latest ADI table, or relevant experience. It's less than 18 months old. That's something that APRA said has to happen. And then back in March 2021, the Institute pulled together an information note on disability income assumption setting. So there's a bit of a background on what's happening in the retail disability income market. The angle we're coming from is the group salary continuance market. So we're questioning, to what extent do any of these considerations apply to the group market? So, APRA's communications continue to focus on the sustainability of, in particular, for the IDII, in particular addressing the uncertainty arising from the product design, including thinking about longer-term horizons. And then in the Institute draft information note, addressed a number of issues, in particular focusing on uncertainty that arises in IDII products, particularly the embedded optionality that is in the product design. There's lots of options, lots of bells and whistles. Trends that have been seen in the retail space, in particular mental health claims, increase over a number of years in mental health claims. The long-term product offerings, there's a lot of long-term horizon, to age 65, to age 70s, and of course, way back in the past, you have the lifetime benefits. And then we're just questioning, repricing, just how effective is the ability to reprice each year for step YRT business, which is predominant in the retail space. So we did a little bit of a comparison. We're trying to think, okay, so what are the features that are in IDII that it's different in GSC, just to try and have a think about what are the difference, or are there similarities? So we looked at three different elements, in particular thinking about the asymmetry side of things. So there's a lot of focus on IDII and presentations that I attended earlier in the summit, talking a lot about asymmetry, and sort of we're just arguing that on GSC, is the asymmetry really there? So the three areas we looked at were optionality, trends and long-term product offerings, and risk mitigation. So on the optionality side, on IDII, there's lots of tiered definitions. There's bells and whistles. Replacement ratios tend to be quite high. You have agreed value. Up until now, there's been agreed value, and obviously a large in-force of agreed value that's out there. And indexation option in IDII, there's a standard indexation formula. For GSC, the definitions are much more narrow, which is driven largely by the CIS Act. Replacement ratios tend to be lower. You do occasionally get agreed value, but it's very low, sums assured versus the salaries. And I think most importantly is that the fund or employer is very involved in the product design and designing the product, for the employees or for the members, thinking about affordability, thinking about the claims process, in designing it. So to me, there's two very different levels of optionality there. The other one's around trends and long-term product offerings. So for IDII, it's quite hard to incorporate increasing trends, particularly in long-term mental health. What we've seen in our portfolio for group business, mental health claims have been reasonably stable for a number of years. So we have not seen trends there. On IDII side, you've got guaranteed renewable up to age 65, make the product very difficult to price. GSC premium rate guarantees are 1, 2, or 3 years at most, so you can allow repricing for trends, and you see a lot more shorter term benefit periods in GSC than you do in IDII. And finally, on risk mitigation, so we argue that the repricing rights maybe not all that effective for IDII, but for GSC, there's the premium adjustment mechanisms that are around, which allows a sort of a loss or profit sharing between the insurer and the scheme or an employer, which sort of allows some sort of sensible way of returning the premiums to the policyholders and it being a bit fairer. So overall, what we're trying to say here is in all the conclusions from the information note that was put out in March, which was an excellent note, really, really helpful for the retail business. But for the group business, we're just questioning just how relevant is it? So do we need a more tailored approach for the group business? Maybe I'll just quickly pause there because we're about to move on to talking about the industry tables. So Hoa, is there any questions come through yet?
Yes. We've got an excellent question. I'll read it out and get one of you to answer. The question is, there is likely to be some anti-selection out of from Jeff. Have you looked at separating that out before you do your analysis?
So we definitely have. I think everyone in the industry is grappling with the same question about, what is the level of opt-in? What is the level of anti-selection in those opt-ins? I think it's fair. I think from what I've seen is that the level of opt-in was quite a bit higher than what the industry was expecting.
Yep.
But there isn't, I think it's too early yet, from what I hear, to determine if the level of anti-selection hasn't really landed yet. So I would say there is definitely some anti-selection that people are allowing for in the experience. I think what we have grappled with is that doesn't fully explain, the volatility that we've seen in the claims experience. And so that was where that led us to wonder if there was an element of accelerated reporting as well. And I guess the accelerated reporting question arises because, we've had PYS and PMIF, we've had a lot of communication to members, and potentially there's been, a lot of heightened awareness and heightened communication with members, and whether that's led to, a spike in claims reporting as a result. But really good question and really important to draw that out.
Yeah, but you have allowed for it in your analysis.
Oh, definitely. Yeah. I think everyone in the industry is trying to allow for it. Yep. It's definitely a major piece of the experience. Yep.
Yeah. I have a question for Matthew. It's a more general question. How has your experience working across many markets helped you with selecting the methodology for reserving?
Thank you. Yeah, so as I mentioned at the start, I worked in America for about a year, and I came from UK originally. Although I've now been in Australia for north of 20 years, so my experience is now a little bit distant. I guess I might just flag one of the big things is the product design is very, very different between the different places. So in the UK, I grew up, guaranteed premiums, for the lifetime of the policy, 10, 15, 20-year level premium, true level premium business. And then in America, what was all the rage when I was there was, the variable annuities and all the fancy, guaranteed minimum income benefits and death benefits and withdrawal benefits that came with that, which was quite complex stochastic levels of reserving required. So the American stochastic experience, probably less relevant, I think, for Australia, given the relative simplicity, lack of, I guess, underlying options and things that would affect, require a stochastic methodology. Although it's quite exciting, I'll say, the stochastic side of things. And then back in the UK, 25 plus years ago now, the system was very different then. If I went back today, I wouldn't recognise the reserving that they were doing. So it's difficult to compare, really. So probably the answer is limited scope to apply what I'd learned overseas 20 plus years ago. Thanks for the question.
Thank you.
I was just going to jump in and add my more recent observation is that the Australian group market is quite unique, like globally. And I think people don't, like in other markets, people don't really understand the significance of, for example, the IBNR reserving and how important that is, and how much that can impact results and impact, your conclusions from experience and impact pricing. So I think in some ways it is challenging to try and draw a parallel with other global products, because Australia is, I think, got that quite unique group product offering.
Thank you, Colette. I have a question or comment. Just listening to you before, the list of methods that are on your list earlier, those is quite a long list, but I'm surprised to see that we as actuaries only use a very small number of methods. And that was partly the reason for the note to be written back in 2014 to introduce, more methods to Australian actuaries. So yeah, we've progressed a little. We've got 20% of people using additive and 20% of people using ultimate loss ratio, but not really that many. And most people still use chain ladder. So a really good and provocative question to consider. Thank you. Maybe we can. Okay, I have a question from Jan. Maybe you can put it up. Yeah. Do you expect that one PYS and PMIF stops, that this volatility will stop? What's your crystal ball say, Colette?
Well, it would be nice if it did. I guess that I don't think the government intervention has necessarily stopped, because we have the Your Future, Your Super changes coming up as well. To what extent that they impact and flow through to further volatility and experience is hard to say. But I think my expectation is that once PYS and PMIF is embedded, we should return to what is like whatever the new normal is. I don't know why. I can't see a reason unless, further changes create further volatility, to be honest.
Remains to be seen, hey?
Remains to be seen.
Maybe I can get Matthew to go forward with the disability termination rates.
Yeah, thank you, Cora. Thanks for your questions so far. Keep them coming. So I thought we'd just quickly talk a little bit about the industry tables. So, back up until 2012, the industry was using the old IAD 89 to 93. And then finally, after a couple of decades of wait, we finally got our new table, the ADI. First of the ADI series came out in 2012, and then just recently last year, an update to the ADI 2014 to 2018. So we're questioning, how relevant is this for group business, given that the data in there is largely retail based. So what are the advantages and disadvantages of using it? I'll be thinking at the moment about termination assumptions in particular, because that's the thing that impacts your level of your DLR. So on the plus side, what was fantastic about the new ADI tables was it had course of claim in there. So whether you had, cancer or mental health or accident and so forth, had different termination factors. And there were other really useful rating factors, which I think would work across group and retail. On the other hand, you have a number of calibration issues. You've got to calibrate it to your group schemes. There's questions about data quality and availability. The treatment of offsets is very different between group and retail. So just leave those thoughts there. So we have another poll question for you. So interested to know, where you are in your journey, if you're a valuation actuary out there, in implementing this new table. So are you still in the Stone Age and using IAD? Are you very big and advanced in using your own table? Or are you now fully implemented the new ADI, or are you something in between? So I'll give you about a minute to put through your thoughts there. Okay, mixed bag at the moment. I appreciate a number of you on this call probably aren't valuation actuaries at the moment, so this question doesn't really apply.
Oh, you can scroll down.
Okay, so it looks like we're an even split. So a third of you, or the one of the three who responded, are still using ADI. One of you, obviously one of the big players, got your own table, and one of you has implemented it for group only. So thank you for that. So I'm just going to quickly hand back to Colette.
So we did do a bit of work to look at, moving from the old table, the IAD table, which obviously is, 30 years out of date now, moving on to the new ADI 2014 and 2018, to try and look and see if it did solve some of the shape issues that we were seeing in trying to fit the old table to our experience. And so in this example, I've just used I just picked a single model point, male aged 35 with a 2 age 65 benefit period. And so in the graph on the left, we've looked at the terminations over the 30 years of claim duration, to try and see overall what the fit is like. And so the main lines to look at there, the green line is an IAD 8993 adjusted. So it's basically applying a flat factor of 50% to that table. And then the orange line is the new ADI 14 to 18. And you can see there that at the start and the end, the fit is pretty good. But there's kind of this area in the middle between claim durations 1 and 3 where the fit is not so good. So we kind of zeroed in on that. So in the graph to the right, that shows the kind of blown up for the first 10 years of the curve. And again, you can see, and that brings it out more starkly, that between claim durations 1 and 3, just applying a flat factor to IAD 8993 does not really provide a good fit to the new table. And I guess what we're seeing is our experience is better explained or can be better fit to the shape of the new table than it can to some sort of adjusted IAD 8993. So I guess that really does provide an argument for seriously considering moving to ADI 2014-18 for GSC, for long-term GSC in particular. And I'd probably add there as well that, people might think, oh, well, at shorter durations, the claims reserves, for short-term claims aren't necessarily that high. But I guess the crucial part here to consider is that those terminations are like a gatekeeper assumption. So if you're assuming more people terminate at those early durations than is actually happening, then you're really under projecting how many people will still be on claim at the later durations where the reserves start to really become a lot higher. So I think it's getting that gatekeeper assumption right. That was kind of an important consideration in when we were looking at this work.
Sure.
We also had a look at tail issues in the old table versus the new table. So the IAD table, after 10 years, it was actually based on CEDA 85, which is an even older North American table. And it assumed that terminations would gradually increase with claim duration, and really mirroring the shape of mortality, those longer durations, which you can see from the green line, but at a much higher level. Whereas the new table, ADI 14-18, proposes a decay assumption, which seems to provide a better explanation of the experience at those longer durations. And as we all know, getting long duration termination experience is difficult and the experience is sparse. And so that assumption really is quite key. And it does make quite a material impact to long-term IP reserves adopting that new tail as well. So they were the two shape issues that we really had noticed in our analysis of moving from, a basis based on IAD to a basis based on ADI.
Great.
And Colette, just a question from me to clarify. The second issue of shape, if you use the new ADI table, the 14-18, using the new assumption would actually lower the reserve for older claims. Is that right?
So the termination rates are actually lower. That orange line is lower, so it actually makes the reserves higher.
Even higher. Yeah. Okay.
Yeah, makes them higher, and that's why I guess it's important to make an informed choice of tail assumption. Yeah.
Okay. Thank you. All right. I've got some questions from the audience. I'll deal with the question first, and then there's a comment. The question is, can you put Daniel's question on, Zoe? Is it helpful for industry? Is it helpful for group to use industry table given that the funds are so different in membership and in nature and so on? It's an excellent question.
Great question. Especially like the use of the word heterogeneity.
Yes.
Very good.
Don't see that enough, do you?
No, you don't. I would say in the group market, a lot of funds, the bigger funds definitely probably have enough experience really to be able to shape the assumptions quite specifically. And so I think what we're looking for here is, to say the retail table is a starting point and gives you something to kind of fill in the blanks, I guess, in the experience. You can't build a complete table from one industry fund, or maybe for the bigger ones, you can get most of the way there. But it's more to say you've got some data points and we've got a table that you can shape for those data points. And so I think it's a starting point. And possibly less relevant as for retail, because obviously it was based off retail experience, but I think still has some value. And, you know, nothing's perfect, but we're kind of comparing, in this exercise, we're comparing the old table to the new one. And our conclusion was the new one is more useful. Yeah.
Thank you. And I guess there are lots of different kind of industry fund as well. The public offer fund, like an Australian Super or a Host, have all sorts of, you know, it's quite a broad range of occupation. Whereas if you have one which is specific to one industry, then I think that comment applies a lot more. So I have a comment from Jeff. Can we put that comment up? The comment relates to the retail business, actually, not the group business. So Jeff is saying that the issue with the IDII is not the claim. The issue is commission. Until you have you stop having high commission, you can't solve the long-term sustainability of IDII product. Now, I know this is a group insurance presentation.
Yeah.
It is an interesting comment, and I was wondering if you would like to comment on it.
Yeah, I'm happy to comment on that. I mean, yeah, really good comment. I mean, my experience in my previous life was largely retail, so I'm starting to learn about the group business. It's certainly a fascinating field. I mean, you talked about the healthy life simply lapse there. So one good thing about group business, you don't have the lapse issue, the selective lapsation effect. You do not get that. So that's one big advantage of group business. There isn't the problem with the high commissions. You know, all the things you've said in there about IDII largely do not impact group, poor value for customers, for consumers. Well, you know, we talked about the funds and the employers' work to design the schemes for the members, for the employees, ensure they have good value. I hope retail can sort themselves out and all the above comments.
Okay. Zoe, do we have comment from the floor? Yeah. You can keep your question coming, but in the meantime, I've got a question for the authors. One of the central proposition in the IN is the fact that actuaries should allow for uncertainty explicitly. And so I'm just going to ask you to comment on that. I think group risk have less issues in terms of long-term guarantee, as you pointed out, but it does have a lot of the uncertainty, the fundamental uncertainty that comes with, selling disability insurance in the current environment. When we live longer and we get disabled, we live with disability a lot longer, and the nature of the disability is also much less clear-cut. Chronic pain, chronic fatigue, back pain, mental health, all of those issues are, I think, endemic. And so the underlying uncertainty for disability insurance, whether it's workers' comp or group insurance, is there. And that's one of the central idea of the IN. So I just want to get your comment on whether you think that applies to group business.
I guess what we wanted to kind of explore or think about is, obviously there is uncertainty in any insurance product, whether it's group or retail. But what we wanted to explore was whether group insurance had the same amount of uncertainty or the same amount of asymmetry, which I think is what the paper was kind of trying to encourage people to incorporate in their assumption setting.
Yeah.
And I think where we're coming from is saying that the features of group insurance products tend to lend themselves to lower asymmetry in outcomes. And part of that is just the mix of products. So it's mainly short-term GSC, which I think we're kind of saying, it doesn't have as many issues as long-term IP. But it's also due to things like we talked about, replacement ratios, things that incentivize customers' behavior.
Yeah.
I think we're arguing that there's fewer things to incentivize negative outcomes, I guess, or, claims experience different to what we kind of expected.
Yeah. To me, it's more of an asymmetry. Sorry.
The issues are different, is what you're saying.
I think possibly the issues might be easier to address in group insurance. For GSC particularly, I think you've got the whole other sphere of uncertainty for group insurance in TPD. I think that's probably a bigger question for a lot of people. Yeah, just because I think GSC doesn't tend to have the same level of long-term benefits and some of the same structural issues that retail does.
Sure. Thank you. Matthew, you were going to say something.
Yeah, well, I get confused between there's asymmetry and there's uncertainty are two different things. I mean, a normal distribution has uncertainty around the mean, but there's asymmetry so I think there's the uncertainty is less, but I think also there's asymmetry that we don't think is as present for group business.
Thank you. Okay, so let me summarize what I've heard today. We've heard that IBNR reserve have been increasing while revenue has reduced for the whole industry for group business. And you've also shown us that the audience tell us that chain ladder method is still the main method being used, with a small number of people using other methods. And your proposition or your hypothesis is that perhaps we should be other methods. Additive is the one that you show us, and you show the analysis. Second, you're saying that the information note you've been looking at that, and you are questioning whether the same level of uncertainty or asymmetry should apply to group insurance, and certainly the issues are different. And thirdly, you show us some really interesting observations about the shape of the termination rates that can be used for group insurance. And your conclusion, or one of your conclusion, is that the ADI table, the latest one, the 2014 and 18 termination rates, is a better shape to use than the previous table. You also show us that in the audience, it's a third actually. So not everyone is using the new table yet. So a very thought-provoking comment and very useful for the audience. So with that, I didn't see any more comments coming through. So I was just wondering if Colette and Matthew, do you want to make any closing remarks?
I did have a couple.
Yes.
Add in. So firstly, there's a session tomorrow at 10:30 on which further explores the impact of PYS and PMIF on TPD reporting patterns. So I'd encourage anyone who has, an interest in that topic in more detail to attend that session as well and ask the presenters some thought-provoking questions. And secondly, just back to a comment you made earlier about the lack of diversity in IBNR methods that people are using or seem to be using. I have seen some quite interesting work done testing actually all those methods that were mentioned in the 2014 paper. And from memory, I think it basically concluded that there's really just a handful of methods that kind of provide results that are considered to be relevant and stable. And I'm wondering if, that sort of testing is a bit more widespread than just, the example I saw. And so people have concluded that while there is, a broad variety of methods, there really is only a handful that have been kind of shown to be, I guess, considered relevant and appropriate for in particular, modelling the IBNR issues or modelling the products that we have in Australia. But I'd be, I'm sure, people have done their own work and looked at that issue as well. But yeah, just to hypothesise that maybe that's why we're not seeing, a broader range of methodologies in use. Yeah.
Yeah, thank you. We've got a new question.
Right.
Management actions via pricing is more effective than retail. So this question is saying, in group insurance, management action via pricing is more effective than retail because you don't have a long-term guarantee. Separately, so that's one question. I think that's not a question, that's just a comment.
It's a comment, which I agree with.
I also agree with. Separately, mostly active life going forward, reporting is likely to be faster. Would member be more
engaged?
And is that good?
For the PYS is remove the inactive lives, and what you're left with is people that are more engaged. Yeah, potentially. Yeah.
So that's an agreement.
Potentially,
yes, right.
Yeah.
It's a reasonable hypothesis. Yeah.
Yeah. Okay.
Yeah.
Matthew, do you have any closing remark? Oh, I do have a question. I have a comment. I think if you have a look at the general insurance actuarial technique, they look at things very differently to the life insurance technique. And sometimes I found it useful when there is a really tricky reserving problem, like the one we currently have and you're trying to address, that it's helpful to get a different perspective. And just answering their question, the reviewer questions about, why do you think this? Why do you, what is the explanation? What is the underlying reason? That's also helpful as well. And they do use very different technique to us, to life insurance. Yeah. So now I'm going to ask Matthew for any concluding remarks.
I guess I'll come back full circle. So I guess please don't panic. Hopefully we've given you some food for thought and, a sense of, how to best sort of navigate the current environment in your reserving processes, and hopefully what we've provided has been helpful.
Okay. All right. We've got 10 more minutes to go, but the question, I'm just checking to see if there's comments coming through. So we've answered.
We're probably okay to finish a bit earlier.
Happy to take an early mark.
Okay.
If there aren't any more questions.
Well, I thank very much to both Matthew and Colette for very informative and thought-provoking piece of analysis that you are happy to share with the community. I think thinking back to my pricing and valuation day, we used to have these discussions, very transparent discussions all the time that I really learned from them. And so I'm really happy that you are deciding to do that and to share the questions as well as the observations. So thank you very much. I'm sure that I certainly learned a lot, and I'm sure everyone in the audience learned a lot as well. So thank you. And remember, there's a as well tomorrow.
Thanks, Far, for sharing.
Thank you for sharing. Brilliant.
Thank you.
Thank you, everyone.
It's my pleasure.